This is Quentin Hardy The Qualifier with a special video about understanding mortgage rates in 2022. There's a lot of confusion. As a matter of fact, as they were setting up the camera and the ring light, someone called me, a guy named Greg, won't say his last name, and he said, well, hey, you know what, we're about to do a refinance, but we probably shouldn't do it because the Fed had hiked rates and mortgage rates are probably so high it doesn't make sense. So I had to explain to him, no, when the Fed hiked rates, mortgage rates actually went down. So let me just clear up a few things and get rid of the confusion about this. First and foremost, and that's where I want to start, is the Fed hiked rates. When people hear that, they somehow hear that the Fed hiked mortgage rates. But if you listen closely, that's not what they say. That's not what they said, because that's not what they hiked. The Federal Reserve has no direct control over mortgage rates. So when you hear that the Fed hiked rates, it's not mortgage rates. And I'm not going to get to on this video what it is that they are hiking because that's not relevant. All we need to understand is what they're not hiking. And what they're not hiking is mortgage rates. As a matter of fact, there is no direct correlation between the Fed funds rate, the thing that they do hike, and mortgage rates. So take a look at this chart. As you can see in this particular chart, we've got the Fed funds rate, the Fed rate, and we've got mortgage rates. Now, this chart does not go to 2022, but I particularly like this chart because they have a zoom in of 2004 to 2007. And look at the Fed rate from 2004 to 2007. They're making it go up, up, up. The Fed kept hiking rates, hiking rates. This is before the 2008 crash. There was some crazy things going on in the market, but they were hiking rates. And what happened to mortgage rates? They're doing their own thing, completely independent. So that is an excellent example. Now, what's happening right now in 2022 is, yes, we are seeing the Fed hiking rates. Mortgage rates are not hiking lockstep. They're doing something different. Number two, this will also help you understand mortgage rates in 2022, is I want everybody to get this. The pandemic did not cause rates to drop. I've been hearing that for the last couple of years as I speak to people all the time. And they say, well, you know, we got these low rates because of the pandemic. Well, the reason I want you to break away from that is that if the low rates were caused by the pandemic, then rates going up are because the pandemic is over. Well, those things seem to coincide, but there is no causative relationship. Sometimes things happen that there's no cause and effect. They just happen to be coincidence or overlap. As a matter of fact, take a look at this chart. And as you can see here, this shows the rates. And I'm just going to show you this little look at where the rates were in October of 2018. And then as we slide across, we can see that the rates are dropping until the end of 2020. We see a consistent decline. So when the rate drop started in October of 2018, nobody was using the word pandemic. I'm not going to get into conspiracy theorists who say that in 2019 it was planned out. Maybe it was, maybe it wasn't. I don't know. All I'm saying is that the general public was not talking about pandemics in 2019 or 2018. As a matter of fact, Barry Habib, who's a well-known mortgage prognosticator, he predicts mortgage rates. In 2019, he was telling the mortgage industry, we are going to see the lowest rates we've seen in the mortgage industry in 2020. We're going to see rates below 4 for the first time. And when I first heard it, I was like, oh, that's interesting. But of course, he's giving his predictors based on what's happening in the economy, in the market, the Federal Reserve, overseas, mortgage-backed securities, bond prices, all kinds of different things. And he said, based on his analysis, we're going to see the lowest rates we've ever seen in 2020. So Barry Habib, he predicted that the rates would be the lowest they'd be in 2020. So it had nothing to do with there being a pandemic or not a pandemic. And I just want this to be separated because if we're looking at mortgage rates this year and or next year and thinking that the pandemic has some sort of influence over them, we want to remove that. Otherwise, we're going to make poor decisions because the pandemic is not what drove the rates down. Here's another thing. Big word, third thing, inflation. This is something you definitely need to understand if you want to have an understanding of mortgage rates for 2022. It turns out that inflation is the biggest driver, or let's say one of the big drivers of mortgage rates this year. Now, why is that? Well, we have to understand what inflation is. Inflation is simply prices going up. There's no super rocket science about it that we need, just a simple explanation like that. So we have to understand that long-term interest rates are significantly impacted by inflation. Well, why is that? Well, think about it this way. Let's say I come to you and I say I want to borrow $1,000 and I'm going to give it back to you tomorrow. Excellent. We don't need to have any special terms. You give it to me today, I give it back to you tomorrow. But let's say I wanted to borrow that same sum or a greater sum of money, but rather than give it to you tomorrow, I'm going to give it back to you in 5 years or 10 years or 20 years. Well, hang on a second. The $1,000 that I'm going to give you back isn't worth $1,000 anymore. I said, what do you mean, Quentin? How can $1,000 not be worth $1,000? If you went to the supermarket with $100 and bought groceries in 2019, and then you took $100 and you went to the supermarket in 2022 and you bought groceries, you got a lot less groceries in 2022. It's the same $100, but that $100 has less value now. So if we were in 2019 and I said, let me borrow $100 and I'll give it back to you in 2022, if there were no inflation, okay, it's only the opportunity cost we have to account for. But once there's inflation, you have to say, okay, you can't give me back $100 because it doesn't have the same value. I can't buy this much in groceries. I can buy this much in groceries in 2019, but in 2022, I'm only getting this much in groceries. So the $100 has less value because it's what can I turn this $100 into? Whether it's the price of a movie ticket, streaming service, gasoline, food, whatever it might be, the money has less value. So when there's inflation and you're going to borrow $300,000, $400,000, $500,000, $600,000, $1 million for a mortgage, and you're not going to be paying that money back for 5 or 10 or 15 or 20 or 30 years, well, now the bank has to account for the inflation in their formula of what they're going to charge you for rates. So when we look at mortgage rates this year, and we notice that from early in the year until the middle of the year, from January to June, we saw a mortgage rate increase that we had not seen in decades. But that's because we have an inflation that we have not seen in decades. See how they go hand in hand? As the inflation is going up, the mortgage rate is also rising. So inflation is the major push so far of mortgage rates. Now, the reason I'm not saying that's the only one, there are others, but that means that as inflation starts to cool down, we can expect that mortgage rate increase will also cool down. There are other factors, obviously, but inflation is one of them, and that's a major, major driver. And that was one of the things that drove it the most, and why we saw big, big moves in mortgage rates, because we were seeing big, big moves in inflation. See how they go together? One other thing to think about as far as mortgage rates in 2022. I hear people say, I'm going to wait to transact, whether it's purchase or refinance, until the rates go back down. And I frequently ask them, why do you expect the rates to go back down? They might not, but are you willing to bet on the fact that they will? And the tricky part is when I hear these people say, well, I'm going to wait till the rates go back to 3.5. I frequently remind them, understand that the rates, these sub-4 rates in the high 2s and the 3s, essentially occurred one time in history in the last 50 years, in the last 100 years. In the history of the mortgage industry in the United States, it's basically happened one time. That being the case, do you think it's going to happen again right now? It might not. It might not happen for another 50 years. Everything is cyclical, these things up and down and up. But are you willing to bet that they're going to go back down? The reason I say this is that those rates that we saw were the lowest ever. Are we expecting that we're going to get back to or beat the lowest ever? Might be a long shot. Understand what's pushing them up. And remember that we had those low rates. We had low inflation or virtually no inflation. So how long before we get back to that? Right now, as we cut this video, inflation is still rising a little bit. So you might have a long wait if that's what you're waiting for. And I don't know how long. So one other thing to talk about. Why did the rates drop then from June to this is the beginning of August when we're posting this video? We've seen rates drop consistently, little by little, nothing dramatic, no huge drops, but they've been dropping. Now, why is that? Why are they going down? Inflation is still going up. And you just said, Quentin, that inflation is the major driver. Yes. Inflation is the major driver. But what's happening to inflation? Well, the Federal Reserve kept saying that inflation was transitory, don't worry about it. And they weren't doing anything. They were just going to let it run. And they even said a little inflation is good for the economy. Let's have some inflation. So they were embracing the idea of having a little bit of inflation. Now that little bit has gotten out of control, and it's a lot of bit, and that's the problem. So why did rates go down? Because the Federal Reserve finally took action to decrease inflation, to quell inflation, to calm inflation. What they did was they hiked rates. Now you might say, well, wait a minute, how does hiking rates, without getting into another 1-hour video, just suffice it to say that when the Fed hiked rates, what they were doing is an anti-inflationary move. They were fighting inflation. And normally they would move the rates 0.25% or 0.5%. They moved it 0.75% in June, which was seen as a big move, as a serious thing that, wow, the Fed is really looking to calm it down and push back on inflation. And the mortgage market, the bond market, the markets that set mortgage rates, they embraced that idea that the Federal Reserve was finally taking inflation seriously and finally acting. So now when they would calculate how much money do you need to pay me back in 5 and 10 years, they're thinking that inflation is not just going to run like this. The Federal Reserve is finally doing something. So rates started to get lower. Then also in July, what happened was the European Central Bank, which is essentially the Federal Reserve for the European economy, because we know that Europe joined their economies. They've got one currency, the euro. The European Central Bank, they hiked rates for the first time in 11 years. And when they did this, it was seen as anti-inflationary. But understand that all of the markets around the world are tied together. There are other countries, governments, entities that are investing in the mortgage-backed securities and the bond market here in the United States. And these companies, there's international conglomerate, everything's tied together. Nothing is operating in a vacuum. So when the European Central Bank hiked rates, which was anti-inflationary, it was seen as a beneficial thing here in our markets as well. And interest rates got a little bit better. Not nearly as much as if the Federal Reserve had done it, because that's our economy, but even the other economy, the echo of the European Central Bank, would help mortgage rates get a little bit lower here. And then in July, the Federal Reserve, the United States, they hiked rates again. Another anti-inflationary move. And so much so that this was the first time we've seen 2 rate hikes like this, of this magnitude, back to back in 40 years. So without having seen this before, now it looks like, man, the Federal Reserve is really getting serious about fighting inflation, and they're saying the right things and doing the right things to say that they're going to continue to fight inflation, that the market has embraced it. And as we do this video, rates are lower today than they were yesterday, and they're lower yesterday than they were the day before. Nothing dramatic. They're not going down by 0.5% a day or anything crazy back to the 2.99 rates, but the rates have been slightly improving. So it's because of all the anti-inflationary moves by the European Central Bank, the Federal Reserve, and what's happening in the market. Those are the things that have made rates, mortgage rates, improve over these last few weeks. Final question, where will rates go from here? Of course, that's the best question. That's why we saved this one for last. And here's the answer. You ready? I don't know. Nobody really knows. We can give prognostications, predictions, and guesses, and some are better than others, but the real reality is nobody really knows what's going to happen to interest rates. Now, I am going to do another video about what happens with real estate values and mortgage rates during a recession, because that's another common question that we're getting. But if you are thinking of transacting, purchase or refinance, since we don't really know for sure what the rates are going to do, it's probably better to not wait. We can't always time the market perfectly, so you're better off transacting. As a matter of fact, take a look at this article. This is from Fortune magazine. Now, I'm not particularly using Fortune. There's hundreds of articles across thousands of different entities that you can find predictions, but they're saying that real estate prices for 2022 should be about an 11% appreciation. That's a very high appreciation. Now, we had about 20% in 2020 and about another 20% in 2021. That is unsustainable. If real estate values continue to go up 20% a year, almost no one would be able to afford a home after a few years. As it stands, there's already a large sector, a large population of people who can no longer afford homes because of that 20% twice, 2 years in a row appreciation. 2022, Fortune says it's going to go up 11%. Maybe it's 8%, maybe it's 13%. It doesn't matter. They're still saying that we're expecting appreciation. Now, the appreciation of 11% is lower than what it was last year. So some people are saying, look, the market is cooling. Yeah, but it's still going up at 11%. So if you are trying to say, I'm going to wait for rates to get better before I buy a house, how much lower does the interest rate have to be to justify paying 11% more for the house? In other words, if you're looking to buy a house and it's going to be 11% more in price, aren't you better off just buying it now regardless of the rate? Especially because the rate is not permanent. Remember, let's say the rates are whatever the rates are and you buy the house and then the rates do drop back to 3.25, 2.99, lowest ever. You can always refinance. But if you waited, it's 11%, and even if the rates did get better, you might not be better off financially. And then look at 2024, they're still expecting prices to go up higher. Whether it's Fortune or whatever other entity you want to look at, rates are expected to do whatever they do, but values and prices are expected to go higher. Now, of course, if you're saying, no, I'm going to wait for the market to crash, that's a whole other video on why I do not expect there to actually be a crash. And remember, a depreciation or a reduction in price, these are not the same thing as a crash. So just a reminder, it is better to have time in the market than to try to time the market. It's time in the market, not timing the market. So rather than wait for rates to do whatever they're going to do and nobody really knows, go buy a house. Quentin Hardy The Qualifier. Be well.